Welcome to the Lone Pine Real Estate Company podcast and radio show, creating solutions to navigating tricky real estate waters. I'm your host, Rachel Umstead, broker and owner of Lone Pine Real Estate Company here in Midcoast, Maine. Real estate isn't always smooth sailing. Whether you're buying, selling, investing, or just trying to figure out your next step, the path can feel overwhelming. That's why this podcast exists, to bring clarity, confidence, and creative solutions to the complex world of real estate. And fun. We all want fun. Each episode will dive into real stories, practical solutions, and expert insight to help you make smart decisions and avoid common pitfalls, all while staying grounded in what matters most: your goals, your future, and your peace of mind. Please note this podcast is for informational purposes only and does not constitute legal, financial, or real estate advice. Listening to this episode does not create a client-agent relationship. Always consult with a licensed professional about your specific situation. So grab your coffee and join me under the pine. Together we'll chart the course. Welcome to the Lone Pine Real Estate Radio Show and Podcast, where we dive into real estate topics that matter most. I'm your host, Rachel Umstead. I'm a licensed real estate agent here in Maine, and today we're going to discuss a topic that really matters to everyone who's buying a house, almost everyone unless you have cash, which I guess then doesn't matter. Joining me is Jo Geidis from Fairway Mortgage. She's a licensed loan officer here in Maine. And before we begin, I'm just going to do a quick disclaimer. I am a Maine licensed real estate agent conducting this interview with Jo Geidis, a licensed loan officer who lends in Maine. The purpose of this discussion is for informational and educational purposes only and does not by itself create an agent-client or a loan officer-client relationship with a listener. Nothing shared during this interview should be considered legal advice or real estate advice. For advice specific to your situation, please retain a qualified professional. So Jo Geidis, I'm so excited that you're here. We've been working together on many loans for years now. So we have, I trust Jo so much. She's a great loan officer, and I really value her expertise with lending. So we're going to thank you so much.
Thank you for having me.
So we're going to dive into some topics. So my question, tell us about you, Jo. Tell us about where you work and how long you've been doing this.
Okay. So I work for Fairway Independent Mortgage Corporation, and I've been here for 6 years. Started in the mortgage industry, working for a local bank. Oh boy, it's probably been 15 years now. And so I worked for a local bank doing mortgages and then moved over to the independent mortgage company side. So we're not a broker, not a bank. We're in between. So
okay, great.
Yeah.
So tell me like what is when someone comes to you or you know of someone who wants to buy a piece of property or buy a house, what do you finance for houses anyway?
So we do residential lending only. So it has to either a land home package, which is that's the only time we can finance standalone land. 1 to 4 family homes, and the use of those homes can be residential, primary residence, residential, rental, so investment property or second home.
Okay, great.
Yep.
When someone is about to purchase a property or they're thinking about purchasing a property, what steps should they take on the financial side as far as what's the progression?
Yeah, so it's always start with a pre-approval, right?
Yes,
so,
definitely. Why do you say that? Like, what can happen if you don't?
Well, you can make an offer on a house and find yourself under contract, and then you can go to the bank to get a loan or a mortgage lender to get a loan and find out that you actually don't qualify. Yeah. Or that what you're trying to do isn't possible.
You can break your own heart. That's what I tell people. Like you can fall in love with the property and think that you're qualified because maybe you had a pre-approval 6 months ago, but things can change, especially with rates. If rates are changing, things can change with what you
Absolutely.
qualify for. So
Yep.
first step is go to a lender and get pre-qualified.
Yeah, and I always say start with your real estate agent and go where they recommend that you go. Like
Right.
they do this every day, and you know, if you're buying a piece of property or a home, you're going to do this not that often. And so, you know, take recommendations from friends and family, but also really listen to your real estate agent, because they are going to have those relationships where they work with loan officers all the time, like day in, day out, and they're going to give you the right one.
Right.
And sometimes it's matching personality with
Right.
loan officer or situation with loan officer, but your real estate agent is going to know you and the lender best and steer you in the right direction. And so meet with a lender.
It's nice to be with a lender too. That I mean, there's things available that are nationwide that
Mhm.
people can go online and get pre-qualified for, but they
Yeah.
don't. They're not necessarily digging deeply enough into your situation.
Correct.
So
Yeah.
sometimes those online pre-approvals
Are not worth the paper they're
right,
printed on.
exactly.
Yeah.
So, and if you, something I like about working with a local person is that
Mhm.
person's, you know, they're invested in the community. You may see them at the grocery store, so they're going to work harder
Yeah.
for you and problem solve versus like some remote person that's
Well, or you don't know the experience level of the other person.
right.
And it's good to talk with your loan officer first and make sure they're going to be a good fit. So,
And that they're accessible.
Accessible, that
Yeah.
they're going to take your call at night, weekends. Like if you're, you know, a lot of times you're going to be looking at homes on the weekends, and you're going to, like, if in this competitive environment where there's no inventory,
Right.
you're going to need to get an offer in, and you're going to need an updated pre-approval letter. I think, and also the guidance of your loan officer. Like some online lenders I know are set up so that borrowers can go in and print out their own pre-approval letter. They can make adjustments to it. But there's something wrong there, because like you can make adjustments to it, but you don't know if it's right.
Right.
Right?
Exactly.
You don't know if it really works with your situation. So it's better to have a loan officer who's going to be there to guide you and advise you, and work with your agent closely on helping get your offer accepted. And the other thing about working with the local lender, in my opinion, is that most of the local real estate agents will recognize like our name or some of the other local lender names, and it makes the listing agent more comfortable.
I totally agree.
Yeah.
Because if you and obviously there's sometimes that a national lender works, so I'm not
Yeah.
100% ruling that out. Just like if you want the advantage and you're in a multiple offer
Yep.
situation and someone recognizes
Yeah.
the loan officer's name and that they're a hard worker and they make things work.
And sometimes I'll get calls from listing agents to say, "Hey, I have a pre-approval letter here from your client, and tell me about them." And so I can advocate for my borrowers with listing agents if they reach out to me. Sometimes I'll ask the buyer's agent, "Do you want me to call? Would it be helpful in this situation to call the listing agent and really put in a good word and advocate and tell you all the work that's gone into us generating this pre-approval letter?" Like when we do pre-approval letters, we're looking at income documentation, asset documentation. We're doing a soft pull of credit, which if you're looking for a lender who's doing a pre-approval, definitely ask for the soft pull of credit, because it doesn't impact your scores. It gives us all the information we need, but without impacting your scores. And then there's another piece to that, which is the credit bureaus are allowed to sell borrowers' data
Okay.
to other lenders. So, and these are called trigger leads. So anytime somebody does a hard pull of your credit for mortgage, there are lenders out there that buy those leads.
Okay.
And so I've had borrowers get like 50 calls. Usually they're getting calls before they even leave my office.
Wow.
Well, once I've done a hard pull. So we really only need to do a hard pull of credit once you're actually under contract.
Okay.
And that soft pull is good for 120 days. And so once I've done your pre-approval, checked income, assets, credit, matched you up with the right loan program, then that pre-approval is good for 120 days. And then all we need to do to refresh that is another soft credit pull if you haven't found something in 120 days.
Right. And so that's very good. I like to say that, like, when you start buying a house, most of the time people don't have tons of experience.
Right.
And maybe their first or their second or third time going to get a loan, and it can feel like you're going to the doctor or something because you're exposed, financially. So
Absolutely.
It's nice to work with someone who's going to problem solve with you and not, be super critical of.
Yeah, there's no judgment.
No judgment.
People live lives and situations happen to people. People lose jobs, people have medical events, and all of that can have a really adverse impact on your credit. And so our job when we pull credit, if it's less than perfect, is to just educate and help borrowers get in a position where they can buy if they can't right now. And my team's really good at building credit action plans.
So I want to interrupt you because that's like a topic I want to go into. So if someone who has bad credit, it's probably not best for them just to wing it.
No.
To rebuild their credit. It's really important if they're thinking about buying to call someone like your team because paying everything off isn't necessarily always the answer.
Right.
So go ahead into what you were going to say about
credit. So it's every credit score, they're based on algorithms, right? And so it's very individualized, and it's really important to the credit bureaus give us all kinds of tools. So we can simulate, like, if we do A, B, and C, what will your credit score be? I mean, it's even more simple than that. Like, so say you come in to meet with us and your credit score is a 560. The minimum score for FHA for Fairway, what we will do is a 580. So in really, if you're a first-time home buyer, we might say, give us an option to get this borrower's credit to a 600 and a 640. And we'll plug that in, and it will spit out an action plan. It'll say, pay down this card, pay off this card. Don't ever close your credit cards. Just pay them down. And as long as you follow the plan, you will get there. You'll get the score, and it'll tell you how long it's going to take you and how much it's going to cost you.
Okay.
And so sometimes if, it could cost you a couple $1,000s to get your score up to a 640, but then you'll have access to like the Maine Housing Authority, which I know we want to get into later, but that might get you a grant of $5,000. So it's well worth it to invest in getting your credit a little bit better so that we can get to where we need to with the loan. Always reach out to somebody who has the access to those tools to run those simulations. So many times I'll hear borrowers say, oh, well, I went into a bank and they told me to get a credit card. That's not always the best advice. Sometimes I'd rather deal with zero credit than bad credit. Okay. So if you don't have a credit score at all and you have no credit history, there are loan programs out there that will allow you to still finance the house. We need alternative credit, which can be a rental reference, a utility bill, a cell phone bill. Just make sure there's something that you're paying on time for at least 12 months in your name, car insurance, gym membership, daycare, all those things count and can give you a great credit reference, even if you don't have a traditional credit score.
Okay, perfect. Awesome. Yeah. So tell us the progression of a loan. Like when someone from like beginning to end, I know it's different with every loan, but let's just take a conventional loan. It can be different even with that, but just hypothetically, what does it look like to walk through the purchase process with a conventional loan? Yeah.
So we ideally will have pre-approved you and we'll have your application. And it's not considered a live application because we have instead of a street address, we'll have a TBD. So it's a TBD loan. And as soon as we get the contract from your real estate agent, we will enter the address, which triggers a live loan application, and that starts the clock ticking. So we have 3 days to get loan disclosures out.
Okay, so that means that when you get the contract from the real estate agent, that means that you've made an offer on a house
It's been
and
accepted.
the offer's been accepted,
Correct.
and then the real estate agent sends it to you,
Mhm.
and it triggers.
A live loan application.
Okay.
Yeah, and that starts our timelines for getting loan disclosures out. So what my team and I do is we set up the file. We'll call you and confirm things like this is our rate that we're going to be floating or locking at. Usually we float to start in this rate environment. And then we, verify things like loan amount, down payment, earnest money. We just have a conversation with our borrowers about what their loan's going to look like. And then we use that information to set up their loan file. We find out who they're going to use for title. And then we send them loan disclosures that they need to sign. Once they've signed those, one of the documents is an intent to proceed, and that allows us to start ordering title and appraisal. And we have a really good system on my team where we send out a very detailed step-by-step email that walks them through the entire process. It also tells the borrower what documentation we still need from them. Usually it's a pretty short list because we've gathered so much up front when we're doing the pre-approval. And then, so once the borrower's signed their loan disclosure documents, we order appraisal, we order title.
Who pays for the appraisal?
The borrower pays for the appraisal.
And when do they typically pay for the appraisal?
That is the one thing that we collect the fee up front because we have to pay the appraiser. If they go out and do the work, they need to get paid.
Okay, so the appraiser, that's one of the fees that's collected up front.
That's the only
fee that's collected up front.
Correct. Yep.
So the loan is triggered.
Yep.
You send out documents for them to sign. You are ordering title. You order the appraisal. They have to pay for it.
Yep.
Then the appraisal happens, which is one of the last steps.
It's sort of, we order it unless there's sometimes depending on the length of the contract, appraisals are happening pretty quickly right now, right? Because it's not as busy as it has been. So we'll order the appraisal unless we're asked to not order the appraisal because we're waiting for inspections to happen.
Okay.
Usually if we order the appraisal, inspections are happening within the first 5 days following contract because of due diligence. And the timing just works out. So we're getting the appraisal in. At the same time, we're working on, we do what's called scrub the file, where one of our loan officer assistants will go through and look at everything, recalculate income, look at the bank statements, follow up on any documents we're missing, remind the borrower to get homeowners insurance lined up, all of those things. Once that's done, we're still waiting on appraisal, we're still waiting on title, but then we get the file into our processor, Brittany.
Okay.
And Brittany's been here forever. She's amazing. And she goes through and has a second set of eyes on everything. But typically it's pretty quick because she's been doing it a long time. But also our loan officer assistant Kat has done such a good job up front scrubbing the file. And even 2 steps before that, we've done such a good job of doing the pre-approval. So everything's pretty much wrapped up. So then we get the file into underwriting. Brittany sends it to underwriting. And then that process typically takes 2 days. And then we get the file out of underwriting. And the underwriter will have set any conditions.
Okay.
Anything that we need to finalize the loan. Usually appraisal, usually title are on that list. Sometimes the verification of the earnest money deposit. But typically our files are out pretty clean. And then we get appraisal in, we get title in, and then we schedule closing.
Okay, great. So this brings up a really good question that I've seen happen.
So simple.
It's so complicated, but you've been doing it for so long that it's simple. Yeah. And no one needs to know all of that because you walk them through it.
Correct.
Every time. And a lot of 99% of the work is on behind the scenes on your end.
Correct. Yeah.
So it's not like the buyer is participating. I mean, they have to do their part and
Yeah.
answer the questions, but they don't.
And get us documentation and get homeowners insurance lined up. But we do try and make it as easy as possible because we know that the stressful part of this is like the inspections and the due diligence and
Right.
any subsequent negotiations. Like that's for me, I'm always like, oh, that's the stressful part of like making sure the deal's going to stay together.
So I'm going to talk about a stressful part that could be stressful for you.
Uh-huh.
What are things people do in the middle of a loan that they should never do?
Yeah. Quit their job. Yeah, don't quit your job. Quit your job.
What if I'm like, you did my credit and I'm right on the edge of like debt to
income,
and I go out and I buy a brand new truck?
Yeah, that's going to stop us dead in our tracks.
So what you shouldn't make any.
No, don't make any big part. Don't use your credit really other than you normally do. Like people will ask me all the time, is it okay to put something on my credit card? Yes, if it's an existing credit card that you already have.
Right.
And so, but don't buy anything new. Don't take out any new credit, brand new credit. Keep making all your payments on time.
Okay.
Do not deposit cash in your bank account. We all funds for closing have to be seasoned for at least 60 days. So cash is not an acceptable form of funds. And the reason for that is, back in the mortgage crisis, the government got very involved in our business because they saw an opportunity to look for not only mortgage fraud happening where maybe the seller's contributing to the down payment, which is not allowed, or also drug trafficking, which is a lot of drug trafficking, money laundering, terrorism, all that. Real estate's a good way to sort of hide that money that,
like dirty money
becoming clean money through the real estate process. Yeah. So that's what's, and I always tell people, we know that you're not a terrorist, a money launderer, or a drug trafficker. We do know that, but these are the rules and they're established for that reason. And so cash is not allowed. Gifts are allowed. So gifts are a great way to, augment your assets. But yeah, definitely don't borrow money for your down payment unless you've had a conversation with your loan officer about it. So secured borrowed funds are allowed typically.
Okay.
Unsecured borrowed funds are not allowed. So a credit card advance to make your down payment or to pay closing costs is typically not allowed.
So what's an example of secured?
So like if you're buying a second home and you're using a home equity line of credit on your primary residence to make your down payment on your second home, that's okay.
Okay.
We just have to account for the debt.
Okay, great. That's great information. And what I want to talk about next is someone who's a first-time home buyer. Not everyone is the same type of first-time home buyer because you can have just like people, you have a wide range of what someone qualifies for and what there is to assist them if they need assistance, because some people don't. So tell us about different programs that people may not, or that we take for granted that people may not know about.
Yeah, so all states have a housing program, and they're all, in what my experience, they're all very different. They have some similarities, but in Maine, for instance, it's the Maine State Housing Authority, and they have a bunch of different kind of facets of their agency, but the one that we're concerned with is the first-time home buyer program, and it's for people who have not owned and lived in a primary residence for the most recent 3 years.
Okay.
So there are some instances where, if you are still entitled to a house with your ex-spouse and you have not lived in that house for 3 years, even though you're still entitled to it, you would technically be a first-time home buyer again.
Okay.
Because you haven't lived in that house. It's not your primary residence. It was awarded to somebody else in the divorce or whatever the situation is. Or you could own a second home. Like if you live in Maine and you've been renting for 5 years and you still own a house that's been converted to an investment property in a different state, like maybe you moved here for work, technically you could you could buy another house using the first-time homebuyer program.
Is it income-based?
It is income-based, yep. So there's income limits by county and by household size. So, give or take, it's around $100,000 for a family of 2, 3 or more. It goes up a little bit. And that's, again, county specific. And so then the advantage of using Maine Housing, one is rate. Their rate is a little bit below market right now.
Okay.
And 2 is there is a first-time homebuyer grant that you can get. You have to complete a first-time homebuyer class, and then you can get a grant of $5,000.
Okay.
And there's also the first gen program that Maine Housing rolled out last year, where borrowers who have never lived in a house owned by their family. So if your parents, your grandparents didn't own a house, you're a first generation home buyer, or you've ever been in foster care, that program discounts the rate even further. It's a full percentage point off of the current Maine Housing rate, and the grant is $10,000 on that.
So is that income based as well?
Yes.
It's all income based.
It's all income based.
So I just want to really recap on that, because that's an amazing program. It's first generation homeowner.
Yeah.
And I didn't know about the foster part of it. So it's if you or your parents have not owned a house, or you haven't lived in a house
owned by a family member.
Owned by a family member.
Yeah.
Or like if you've ever been in foster care. Correct. Is it both of them, or just like if you
one or the other?
One or the other. Wow, that's amazing.
And only one borrower. So if you're a couple borrowing, if we have a borrower pair, then only one of those borrowers has to meet that criteria.
And then you get a $10,000 credit. Great. And what does that go towards?
Either down payment or closing costs, or both, depending on the program. So Maine Housing as a standalone program would follow conventional guidelines, and you would have to put 20% down. Okay. But the great thing about Maine Housing is that you can combine it with USDA. Okay. The guaranteed program. So that allows for up to 100% financing. So Maine Housing is giving us the money. USDA is guaranteeing the loan. Okay. And you combine those two programs. You can also combine Maine Housing with FHA and VA. Okay. And we follow the program guidelines for FHA, VA, and USDA. Okay. USDA also has income guidelines, so typically Maine Housing's a little bit more restrictive than USDA, but they're kind of in the middle. So we have to make sure you meet income guidelines for both programs.
Does FHA have income guidelines?
FHA does not.
Okay. And then VA does not either?
No, but you have to be a veteran.
Right. Yep.
And Maine Housing actually discounts the rate for veterans as well, 0.5%. So off the going current rate, which is great. And with veterans, they have the Salute program where you don't have to be a first-time home buyer. You can't own 2 primaries at the same time, but if you've recently sold a house and you're moving to Maine, or you're just moving within the state, even as long as you've sold that current primary residence, you can immediately turn around and use Maine Housing. Okay. Again.
So that's with VA.
It does not have to be a VA loan, actually.
Okay.
So if you're a veteran and you don't want to use the VA loan program for whatever reason, like for instance, if you have sold your house and made enough so you have a 20% down payment, we don't need to use the VA loan program. We can just use Maine Housing in a conventional.
So you can use Maine Housing in conventional, but there still are income even with the VA.
Correct.
Okay.
Yep.
So just to clarify that.
Yep.
So an important part of all of this too is that the house has to qualify for all of these, and they have stricter guidelines for houses.
Maine Housing does not.
Maine Housing does not.
Maine Housing does not. Maine Housing does not require a water test. That is a common misconception.
Okay. Do they have any requirements?
Maine Housing is going to follow conventional guidelines. If you're just using Maine Housing and you're not combining it with USDA, VA, or FHA, Maine Housing is going to typically, they follow Fannie Mae guides. Okay. So you're going to have to make sure that the house meets Fannie Mae. Okay. And the borrower meets Fannie Mae guidelines. And then Maine Housing has some other guidelines with credit, which are important, but This is why it's so important to work with
This is why it's important to work with a realtor and a lender, because the lender knows the lending side, like what you need.
Yeah.
And the real estate agent, which I do for most programs, like, I know you need a water test
for USDA and VA, and that's it.
So there are certain things that you need to know, and VA is no chipping paint.
Well, so government loans are all the same, typically. So USDA, FHA, and VA don't allow for things like chipping, peeling paint. But
you can work around that.
It's
not always a deal breaker.
No, it's not. I have not had a property condition issue be a deal breaker in forever, because you just have to get creative and deal with that. But I would say even conventional loans now, like moisture in basements, missing handrails, missing steps outside, decks in disrepair that have rotted boards, damaged, missing siding. Even on a conventional loan, if the house is if the paint is basically gone and it's just exposed wood, you're going to have a problem with that appraisal.
Okay.
Worn, if the appraiser uses the term worn as in regards to roof shingles, you're going to have a problem. And that's across the board. Like Fannie Mae and Freddie Mac are really cracking down because they do not want distressed properties on their books. And they want borrowers to be set up for success going into homes and not have major, repair bills awaiting them that are going to really not help them be successful homeowners. And also safety and soundness. It's just we want homes to be safe and sound. But there's ways to work around that. So as long as it's not an immediate health and safety issue, we can usually do an escrow holdback to take care of repairs after. So
and that has to be agreed upon between the buyer and seller. So it's super important to go into it with your eyes wide open with an agent that knows how to navigate and a lender who knows how to navigate. Because if you're going into it blindly, it can become this massive roadblock that maybe people just give up. But if you go into it with an agent and a lender who's prepared, who knows how to problem solve and walk you through it, then it doesn't mean, in most cases, it doesn't mean that it's a deal breaker.
No, and I again, we have dealt with so many issues, and it's, it's like, so septic's failed. That's an easy escrow holdback. We do those all the time because it's Maine and septics fail, and everyone, unless you're immediately in a town, and even some of the in-town homes still have septics. It can stop a transaction in its tracks, but if you can work around it and the buyer and seller can come to terms, then let's get it fixed and move on. Same thing with roofs. Peeling and flaking paint, well water quality issues, all of those things can sort of be dealt with. The things that are of immediate concern typically would be a furnace not working.
Or having a heat source, because sometimes you have a house that doesn't even have a heat source.
Sometimes you do, yeah. And so I even love to deal with those because, it's like throw a Rinnai heater in, right? And get some propane delivered and let's go. Let's close. And then, because it depends, and, these days heat pumps and that sort of thing. It's pretty common in Maine to not have heat on the second floor in some of these older houses too. So we just need the appraiser to comment. Sometimes we'll need to get an HVAC person out there to say it's very normal, and the heat source on the first floor and the basement is sufficient to heat those second floors. So sometimes lenders will just sort of like not have seen something before, and so they don't understand it. And it's like, this is very common in Maine. I mean, I owned a house that didn't have heat on the second floor. And it didn't need it. It all kind of floated up the stairwell. And that's, I think, the thing, plugging Fairway a little bit, but we are a national company, but we operate very regionally so that we
Yes.
understand regional differences.
Which is super important when you're dealing with issues. It
Yep.
can go super smoothly, but
Yeah.
in a lot of transactions, you'll have some type of
Yeah.
bump in the road.
Yeah. I would say two things probably that are the biggest deal breakers. Electrical issues, because those really need to be corrected prior to closing because
Okay.
of it's hard to get an electrician to say that is, we could with an inspection get an electrician to say, oh, the house isn't going to burn down, but most aren't willing to say that.
Right,
Like
because they don't want to be on the line.
They don't, and I don't blame them.
I don't blame them either.
Yeah. So the electrical issues that are
like knob and tube.
Knob and tube's okay if it's in good repair.
Okay.
And typically that's more an issue with insurance companies, but most of them will write a 30-day policy. You just have to kind of get it corrected pretty quickly.
Okay.
But if the appraiser doesn't comment on knob and tube and it's in good repair, it's not typically against code.
Okay.
Most towns have grandfathered it.
Okay.
So, maybe it's something that's negotiated into the contract and it's done as a seller credit and corrected after. As long as the appraiser doesn't comment on it and it's not in disrepair, it should be fine. But mold, that'll stop us dead in our tracks every time. And then it's a mold inspection and mold remediation prior to closing typically. Unless we're doing a renovation loan, then we can do it after. And then handrails are always a must prior to closing.
Okay.
I've seen doors that open to the outside, no steps, no deck. Those are, and sometimes you can, if it's opening onto a deck that's not there, you can get away with a lock usually, or a bar, or some other really significant locking system, so people don't just walk off.
Or like a small child can't open it.
Exactly.
Right.
But if it's one of the major ways of ingress or egress, you have to put the steps back and have that. So if it's a front door or a side door, and that's one of the ways that you would get out of the home in a fire,
right,
you got to put your steps back.
Okay.
And that'll catch us every time. So mold is a big issue that needs to be addressed
before it closes.
Right. Yeah, just because it's such a health and safety issue.
Okay, so I think that we've covered a lot about the government loans.
Yep.
And even touched on a lot that conventional.
Yeah.
Because conventional, you do have an appraiser and things can be flagged with conventional as well.
Yep.
So I wanted to, now I'm forgetting where I wanted to go with this, but.
Different types of loans?
Yeah, exactly.
Yeah.
That was it. Thank you.
Yeah, no problem.
So there are types of loans
Yeah.
there's like the standard types of loans, conventional, USDA, FHA, VA, and you don't deal with commercial, but there can be commercial loans, but
we'll do up to a 1 to 4 family investment.
So you do deal with investment, but then there's these loans that the general public just doesn't know about.
Yeah.
So tell us about some of those.
So these are called non-QM loans. There's a couple different kinds. So there's jumbo loans, which is anything over the conforming loan amount, which in Maine for a single family is $806,501. That would be considered a jumbo loan. So there are banks and investors out there that will do jumbo loans.
Okay.
And some of those rates are very favorable.
Okay.
So, but they have all their own different sorts of rules. So you sort of have to, and every investor's a little bit different. And so it's just a matter of kind of matching your borrower situation and the house up sometimes with the lender that's most favorable in terms of rate and program guidelines. And then non-QM loans. So a QM loan is a qualified mortgage.
Okay.
That means it's basically underwritten to Fannie Mae, Freddie Mac. It follows the ability to repay rule, and it's something that's basically quasi-insured by the government, right?
Okay.
So if you run a loan through Fannie Mae or Freddie Mac and you get an approval or an accept eligible, that's considered a qualified mortgage. And that means if Freddie and Fannie are going to buy that loan from us when we originate it. We will still service it we'll do the servicing, we'll accept payments, but Fannie and Freddie will own it. A non-QM means it's a non-qualified mortgage. So it has some element of it that doesn't meet secondary market guidelines, Fannie Mae, Freddie Mac guidelines, or government guidelines. And that could be maybe we have a self-employed borrower.
Okay.
And for one reason or another, the income that they're showing on their tax returns isn't really indicative of their true income that's coming in. Maybe their business is expense heavy or whatever. We can use, so we have an option for 1099s. So instead of looking at the borrower's tax returns, we just get the 1099s that they're issued.
Okay.
And we can use those. We can use business bank statements, so 12 to 24 months of business bank statements, and we get those analyzed, and we look at the income that's coming in through those business bank statements, and use that as income instead of tax returns.
Okay.
We can do debt service coverage loans, where this is for investment properties only, where we get the appraiser to tell us the rental income, or we use leases or a combination of both. And as long as that debt service coverage has at least a 1-to-1 coverage, and it can go 1 to 1.25, I think, coverage amount for the PITI payment on the house, principal, interest, tax, and insurance payment on the house, we use that for income instead of using the borrower's income.
So I'm going to say that in a different way.
Yeah.
So if someone goes to buy an investment property and the rental income is, let's say, $10,000 a month.
Sure.
And it covers the taxes and insurance and the mortgage for that month. Yep. Then it potentially would qualify.
Correct.
Okay.
Yep. Absolutely. Right. And so those are a couple of the options. There's loans that use assets as qualifying income.
Okay.
That happens on the conventional side too, but also there's a non-QM option for that. So those are some of the kind of loans that we can do and get creative with if we need to.
So that's great. Now, you brought up, and some of these probably have higher rates to them.
Sure.
But let's talk about rates.
Yeah.
And I know, so what's your, this is just your opinion. What's your opinion, not about like where rates will go, but like people waiting on rates to change to buy or sell property? Like what?
It's while you're waiting, home prices are going up. And so you could, or you're waiting and you're not starting to build equity in your own home. You're paying off your landlord's house.
Right.
Yeah. And so you're missing out on an opportunity now. And rates were artificially low during the pandemic, right? Because the Fed was printing money.
Right.
It was a sign of a very unhealthy economy, unfortunately. And so while rates seem to benefit borrowers, and they did, it had the effect of, one, driving up home prices very, very quickly. Two, it just wasn't a good thing for the economy in general. Like, you're paying 3% for your mortgage, but you're getting 0.5% on your the money you have in savings accounts. So, you're missing out on opportunities to earn money, while you're spending a little bit less on your mortgage. And what happens when you want to sell that house and that house doesn't work for you anymore? Well, now you're feeling like
you have to hold on.
You have to hold on just because of that mortgage rate, right?
Right.
And so that doesn't make sense. Like, we all have to live our lives. And in this 6% to 7% mortgage rate is pretty average over, if you look at a 40-year span, it's definitely not the high.
Right.
Not the low either, but it's kind of more
decent,
to the low end of the average, right? So it does impact affordability, and I get that. But the other side of what's impacting affordability is home prices, and that's an inventory problem. And so I tell people, don't get emotional about the rate. Get emotional about the house, right? You have to live your life, and it's if it's affordable for you, don't get emotional about the rate.
And historically, home prices, they may have some little dips, but historically,
appreciation.
Like, for as long, I remember you showing me a graph for as long as
Yep.
we've been tracking
It's
real estate.
yeah,
It's
it
just
goes up.
gone up.
Yeah, it is the single best way to build generational wealth that's accessible to everyone. Like it'd be great to have that like invention or that one thing that you've done that you can then sell for $1 billion, like Jesse Itzler. But
Right.
as we were talking about earlier, but that's not going to happen for most of us.
Right.
So we have to find the other ways that we can invest in, a piece of real estate, and that's going to appreciate over time. And I'm not saying like don't pay attention to rates. Definitely pay attention to what's affordable, but don't wait just because you're waiting for rates to come down from 6.875 to
Right.
5.875. You
'Cause
don't
it might not
you
happen.
you might not happen.
Right.
And no one has any control over it.
Right.
It's just so outside of our control, and you can't live your life based on things that are outside of your control.
Very good. Do you have anything else you want to say? Anything, any tips,
My tips are, if you're trying to sell a house, don't for sale by owner. It's, use a real estate professional, and get pre-approved. Those are my 2 tips.
Those are good tips.
Well,
thank you so much for coming. I really appreciate it, and we'll have to do this again.
Yeah, thank you
you so much.